The rise of ESG investing, how to profit from socially responsible investments. In recent years, the financial world has witnessed the rapid rise of ESG, environmental, social, and governance, investing. Once considered a niche strategy, ESG investing is now becoming mainstream as investors increasingly prioritize sustainability and social responsibility in their portfolios. Whether driven by personal ethics, growing regulatory pressure, or the belief that socially responsible companies offer better long-term returns, ESG investing has proven to be more than just a trend. It's reshaping how we think about profitability and ethical investing. In this article, we'll explore the fundamentals of ESG investing, how it works, and how you can profit from this socially responsible investment strategy, while aligning your portfolio with values that contribute to a better world. What is ESG investing? At its core, ESG investing integrates environmental, social, and governance factors into the investment decision-making process. Unlike traditional investment strategies that focus solely on financial returns, ESG investing takes into account a company's broader impact on the world, assessing its performance in three key areas. 1. Environmental E. This pillar assesses how a company's operations impact the environment. Factors include carbon footprint and greenhouse gas emissions, water usage and waste management, pollution control, adoption of renewable energy sources. Companies with strong environmental practices often appeal to investors concerned about climate change, natural resource depletion, and sustainable development. 2. Social S. The social component evaluates how a company manages relationships with its employees, customers, suppliers, and communities. Key factors include employee working conditions and diversity, human rights practices and labor standards, consumer protection and privacy issues, corporate involvement in social issues, healthcare, education. Companies with strong social practices are more likely to create positive community impacts and foster loyal customer bases. 3. Governance, G. Governance focuses on how a company is run, including its leadership structure, ethical business practices, and transparency. Factors include board diversity and independence, executive compensation, anti-corruption policies, shareholder rights. Good governance practices are essential for reducing risks, ensuring accountability, and building trust among investors. By combining these three pillars, ESG investing seeks to identify companies that not only generate profit but also promote sustainable development and ethical governance. As a result, many investors believe that ESG-aligned companies are better positioned to withstand regulatory changes, market shifts, and long-term risks. Why ESG investing matters today. Several factors have contributed to the rise of ESG investing in recent years, making it a more attractive option for investors looking to align their portfolios with sustainable principles. 1. Increasing consumer and regulatory pressure. Governments and consumers alike are placing more pressure on corporations to act responsibly. Environmental regulations are tightening, social movements are gaining momentum, and corporate governance is coming under more scrutiny. Companies that do not meet ESG standards risk losing customers, facing fines, or experiencing reputational damage. 2. Long-term sustainability. Companies that embrace ESG principles often exhibit better long-term sustainability. By mitigating environmental risks, promoting fair labor practices, and implementing transparent governance, these companies are more likely to avoid scandals, legal issues, and market volatility. This often results in more consistent long-term growth and profitability, making them attractive to investors. 3. Strong performance in financial markets. Contrary to the misconception that socially responsible investing sacrifices returns, many ESG-focused companies have delivered strong financial performance. Numerous studies suggest that companies with good ESG practices outperform those with poor practices. In fact, ESG funds have been shown to perform on par or even better than traditional funds in certain market environments, especially during periods of volatility or crisis, the COVID-19 pandemic. 4. Millennial and Gen Z influence. Younger generations of investors are increasingly prioritizing values-driven investing. Millennials and Gen Z are more likely to invest in companies that align with their personal beliefs about environmental conservation, social justice, and corporate ethics. This shift in generational preferences has contributed to the growth of ESG investing as financial institutions cater to these values-driven investors. How to profit from ESG investing. ESG investing isn't just about aligning your investments with your values. It can also offer substantial financial benefits. Here are some strategies to help you profit from ESG investing. 1. Select ESG-certified funds and ETFs. One of the easiest ways to gain exposure to ESG investments is through ESG-certified mutual funds and exchange-traded funds, ETFs. These funds pool money from multiple investors to invest in a diversified portfolio of companies that meet certain ESG criteria. Many ESG funds target a specific area, such as clean energy, sustainable development, or ethical governance, allowing you to choose a fund that aligns with your values. 2. Invest in clean energy and green technology. The clean energy sector has been one of the biggest beneficiaries of the rise of ESG investing. Governments around the world are increasingly supporting renewable energy initiatives as they look to transition away from fossil fuels. Companies involved in wind, solar, electric vehicles, and battery technologies are poised to benefit from this shift. 3. Identify leaders in corporate social responsibility, CSR. Companies with strong CSR initiatives often enjoy enhanced customer loyalty, brand recognition, and employee satisfaction, all of which contribute to long-term profitability. Look for companies that are recognized for their social impact, community engagement, and ethical labor practices. 4. Focus on companies with strong governance practices. Corporate governance is crucial in identifying companies with long-term growth potential. Poor governance can lead to mismanagement, scandals, and financial instability. Companies with strong governance practices are more likely to manage risks effectively and provide consistent returns for investors. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.